Good afternoon, everyone, and thank you for joining us for today's webinar series where we will cover MediaValet. My name is Babak Pedram of Vertus Advisory. I'm joined today by the CEO of MediaValet, Mr. Rob Chase. We will start with formal introduction of the MediaValet story. At the end of the presentation, if time allows, we will go through a number of questions that we have already received by email. MediaValet is a software as a service company based out of Vancouver. The company is listed on the TSX under the symbol MVP. MediaValet's current market cap is 46 million, trading at approximately 3 times 2022 ARR, which is the annual recurring revenue. The company has an impressive track record of delivering 20 consecutive quarters of annual recurring revenue growth. With that, I will hand over the call to Rob to introduce the MediaValet story. Please go ahead, Rob.
Thanks, Babak, and welcome to the investor update, everybody. Great to have you on the line. Just quickly, before we get into it, the normal safe harbor statements will apply regarding forward-looking statements, and please take note of that. Key takeaways for today as we get into things here. I hope that we can get some key messages across for everybody. Pieces that we believe in and hope are clear from our presentation, and that is that we've got a sustainable and proven ability to win in a high growth market. The DAM growth market itself grew at about 19% last year, while we grew 37%. So we're exceeding the market growth, but also in a high growth market. Optimization and alignment driving baseline consensus growth. Again, we've got a great team in place. We're focused on optimizing our spend and our operations to make sure that we're driving impact for our customers and, of course, ultimately growth for our business. And we're on the cusp of cash positive operations. We have analyst consensus for positive cash from operations in Q4 2023 and for fiscal 24 as a whole and beyond. And that there's upside opportunities from our feature and platform launches that we'll be executing this year, from large deal activity and from partner activation. All of that summarized, as Babak mentioned earlier, at an attractive valuation entry point with multiple expansion opportunities based on the near-term catalysts that we'll cover in the deck here. So hopefully you all come away with that from today's call. Turning to MediaValet, and as Babak mentioned, 20 consecutive quarters of net annual recurring revenue growth. We're focused on being a leader in the enterprise digital asset management market, a SaaS leader. And digital asset management space is simply managing all of the content that organizations have to create to be an effective digital organization. So you can well imagine there's a big tailwind from digitization of everything. And having your content looked after, properly managed well, is going to make sure you're going to be able to be efficient and effective in your digital strategy, grow revenue, reduce costs, is what we offer our customers. Our customer base has been growing nicely. We now have over 485 customers. I expect we'll hit 500 very soon here. We've got about 14.78 million in annual recurring revenue, up 36% from last year with a 43% 5-year CAGR. And we're retaining nearly 100% revenue every year of our annual recurring revenue. In fact, 101% in 2022. So that creates a nice, effective snowballing effect that every time we add a new customer, just keeps adding to that growth. So the beauty of the SaaS model starting to show there. From an analyst consensus perspective, we're expected to continue to grow in fiscal 2023, despite some of the economic headwinds that everybody has been concerned about, that no doubt will increase some sales cycles, but still great growth ahead. Analyst consensus, 18.65 million to finish the year in 2023. And as I mentioned earlier, cash positive operations on the way. Differentiated technology, we've invested heavily in innovation and in our customer platform, delivering and focused on delivering customer value in the digital asset management space and differentiating us as a vendor within there. We're well funded, 5.8 million of adjusted capital, including our $3.5 million equity raise that we completed in January 2023. And we also have access to a $9 million line of credit to cover any bridges we need on our path to cash positive here. And as you can see on the charts on the right here, the nice consistent growth in our annual recurring revenue. And when you look at a quarterly resolution on our operating costs, as you can see, they are plateauing here after our big year of investment in 2023. So we're holding the line on operating costs so we can grow into cash positive operations. And that's the focus. You can clearly see us holding it there in the on the bars on the right for the quarterly resolution. Turning to the DAM market itself, these are some analyst projections that were done in early 2021. There's various ones coming out now with continued high growth estimates for the DAM market. You know, the tailwind for this market is, as I mentioned earlier, the digitization trends. As you start building out your digital strategies, you start to realize that content is king, and if you don't look after your content, you're just not going to be successful. The problem is that content is hard to manage. It's everywhere. People store it all over the place. And every marketing stack tool that you use to reach your customers has its own tiny library of assets that you work with. You can imagine the mayhem and the value that isn't being created by having a disjointed content strategy. DAM brings all of that together and not only increases the value of the assets that you're creating because you always have access to them, you can search them, you can discover them, you can reuse them, but also increases the value of the systems that you use to reach your customers. So you know, creates that fortuitous circle by having a DAM at the hub of your content strategy. And as a result, we mentioned that we have a 43% 5-year CAGR outpacing the growth of the market itself, and obviously a sign that we're continuing to grab additional market share in this robust market. How we do that is we have a differentiated brand promise. The first is that we focus on being easy to use. It's a very complex area to look after digital assets. What we want to do is make sure that customers can get up and running and realize the value of DAM instantly. They can, of course, then implement all the complexities they want if they want to grow this to a full enterprise solution by leveraging our application programming interface that enables customers to tie MediaValet into all of their marketing stack of tools and other foundational tools they use that rely on content. That ease of use is critical, and it's an area where we stand out, and it's how we approach what we do. We also have hyperscale. Simply put, you can't outgrow us. We support today customers as small as $6,000 US a year to customers as big as over $700,000 US a year. So complete from SMB all the way up to large enterprise. And those customers can keep growing as fast as they wish. Our system will be right there for them to support it. We also have unrivaled support. We're best in class for support and well known for it in the industry. You know, as we like to say inside, our moniker is that we care. We're experts in the space, and we want to help you realize the value, and our customers feel that every day. Enterprise security is important for us. We have a global footprint of data centers that can't be touched by the competition. We have data residency guarantees in many regions around the world. SOC 2 compliance, single sign-on to ensure that you know, all of the policies that your organization uses are aligned in with the DAM. We have innovative solutions as another core focus or standout areas. We don't just provide plain vanilla features. We really try to provide solutions to the customers and make the system as value adding as it can be, so customers can achieve their goals for their content. And of course, it's secure. We're built exclusively on Microsoft Azure platform as a service. Not very many organizations attempt to do that. We do everything in the Microsoft Azure cloud, including our dev environment. You know, the concept of people developing in a garage, for example, doesn't exist. It's all in the cloud. Including our delivery, everything. We get certain advantages out of that, including some of the hyperscale capabilities that and global reach that we have. But all of this leads up to best-in-class customer adoption, which is a real focus area of ours. And so when we look at how we stand out in the crowd, again, you know, we talked about, you know, the we care, unrivaled support, the ease of use, and the innovation. You know, at the center of that, we see best-in-class adoption is what we're delivering to our customers. As far as I'm concerned, if you're missing a few features here and there, as you always are in technology, if we're best in class in adoption, it doesn't really matter that much. We're going to win more than our share of the market simply because customers know and can count on us to get the value that they seek from DAM. And that value message really resonates in our core market. We're focused on the mid-market, that mid-enterprise, large SMB through to small enterprise. That's really our sweet spot. As I mentioned earlier, we span the entire market. We have a lot of competitors that are in that SMB to mid-market space, small mid-market space, with plain vanilla type features and less of a solution-oriented, best-in-class adoption-oriented type approach. And if the customer truly has an enterprise type use case where they have high value, high volume digital assets, then they do fall in more into our category than into the plain vanilla. We also do reach all the way up into large enterprise, though we're not really established to go after that market per se. I think you'd find a lot of that market really heavy on professional services, organizations that kind of have 60% recurring revenue and 40% professional services. Whereas an organization like MediaValet, we have 95% of our revenue is recurring. And as you can see, the mix of customers reflects this strategy. 20% of our ARR is actually coming from our largest customers. It's only 3% of our customers, though. Most of our customers, in terms of logos, is in that mid-market space. 70% of our ARR, and another 10% coming from the SMB type of contracts or customer use cases. Those could actually be enterprise type organizations with us just having a division within, for example. Overall, average contract value or ARR being about $23,000 US per customer. In terms of our R&D spend and adding value to the customer and innovation, some of the things that we are focused on this year is a UX refresh, which is a customer experience refresh, to increase the flexibility and value delivered to customers, and also to accelerate partner enablement and integration, which is pretty critical. As I mentioned earlier, DAM is really the hub of your content strategy. We have to partner and play really well with all of the other tech solutions that you rely on that need that content. So this is a pretty critical piece for expanding our TAM and winning more in the market. And of course, the new UX refresh that we're delivering will also increase our rate of innovation. And just as a little tie-in back to the history, back in 2018 we delivered V4 of our UX. That was a big thing for us, and was what started our rapid growth trend. The year after, we grew 85% in ARR. So these things will have strong impact in the years ahead. We're also focusing this year on back-end optimization, and part of this is making sure that our customers are able to maximize their adoption of the system, being able to manage our storage intelligently, being able to handle massive amounts of video and mass scale accounts. We're expanding our TAM by enabling us to do just this. And so back-end optimization is a key focus this year of our team, as always, innovative features, and of course, being a foundational layer. We're a pure play DAM player, but we are very focused in that regard. So it really leads us to focusing on things like ensuring we have the broadest asset type coverage of any DAM out there, that we have an organization-wide use case for that coverage as well. Video is a very big piece of this at the moment, and you can see some sort of things down below there about how we interact with video and help customers to pinpoint exactly what they're looking for within all of their videos, so they can apply AI searching and find what they need, and importantly, reuse little snippets from each of these reels that they have going forward for adding value as a marketer or as a business. Now, in terms of our go-to-market, we're predominantly a direct marketing and sales organization. Most of the deals that you see us generate, in fact, over 90% are just from our direct marketing. It's a demand-rich environment. You can see some of the examples of the pieces that we go to market with, a lot of search engine optimization, things like that. What we're really leaning into right now is our Hot DAM campaign, really how we stand out as a hot DAM in the industry. And we took you through the we care, the ease of use, and the innovation leading to best-in-class adoption. That to us is hot DAM. And that's a category we're defining and pushing here in the market to differentiate MediaValet from the kind of plain vanilla we see out there in the competitive field. the same time, we're augmenting our sales, our direct sales efforts by partnerships and continuing to expand our partnership ecosystem. A lot of this is about having really good integrations and tie-ins with other key marketing stack tools and leveraging that to make us stand out and bring opportunities our way. So we're pretty happy with what we've seen and the opportunity we see ahead. There's lots of untapped opportunity here within the partnerships. Today, it's only generating directly under 10% of our business, but it's influencing another 20. A lot of that is around the, because we've integrated with the right types of tools and partnerships, so that the relationship itself tends to bring us some good opportunities and influence those customer decisions. In any event, that's an area where we'll be leaning in this year to enable these partnerships. We see Microsoft on there. They've been a great technology partner. And this year we're focused on enabling them as a true go-to-market partner. And if we can do that, that'll be significantly change the scales here for us, so we can get partnerships to become a bigger piece of the overall puzzle. Looking at our proven success from a customer perspective, as I mentioned earlier, over 485 customers, growing nicely, a good ACV at 23K US. It's actually, our ACV is up about 40% from 2018. So we continue to grow our ACV and a net retention 101% this year. You can see what the prior years were like. Obviously took a bit of a dip in the COVID years, but holding strong now at 101%. And of course, our team is maturing in their ability to go and upsell these customers. We've always had best in class gross churn levels, about half of industry standard. But we've been, lower on the expansion side traditionally, just because of the state of development we're in. And I think we'll start to see us improve that this year. Again, at least retain our 101% again, with a long-term goal of getting to 105 to 110% net retention. Few examples of some recent customer wins. What you'll see from us is every quarter we'll do some announcements on customer wins that are generally double the average ARR value in our customer base. So do watch for us to do those. They're just great indicators of that we're reminders of what we're up to. And the customer base that we support is highly varied. There's no real concentration. We do have about 12% in high ed and about 10% in manufacturing. So there are some bigger buckets, but no customer or real market segment concentration. We've got an auto parts manufacturer that we've just signed recently. Good sizable customer. You can see the genetic makeup of that deal. An annual recurring revenue of nearly 86,000 US. Some setup fees to get them up and running and get them trained, 10,000 for that. And in this case, we actually did some professional services for this organization to really help them nail their taxonomy and their library services and maximize the value for this customer right out of the gates. Very excited when we can add some PS into the mix here, because it makes our customers better. We also learn more about their needs and can then go and productize that for other customers as well. So you can see it's a one-year term. Generally, that's what we sell. We don't push for more. Sometimes customers will ask for it, and we're happy to provide that when they do. You can see the agency group that we signed up recently. That's a South African organization, wanted to pay 3 years in advance. We're okay with that, but we're not going to push for it because our net retention is so strong. We're just happy to get a one-year deal done and carry on adding value to the customer and be held accountable for it as an organization. And you can see a telecom provider as well. It's a Canadian telecom over here on the West Coast. And, they called out when they did their evaluation of MediaValet, that ease of use really stood out for them. And also the unlimited support and the hyper scalability were all very important pieces for this organization to get going. They're an omni-channel type of organization. As you can imagine, our telcos are. They've got cell phones, they've got stores, they've got online, they've got both business and consumer. So a very complicated media situation there and go-to-market strategy that we can significantly help to optimize for them. And, that's their key focus. And right now, a lot of organizations are looking to optimize operations, right? What can we get rid of that's duplicative? What can we do better so that it's more efficient? And fortunately, as IDC says in the DAM world, if you implement a DAM, you'll have an 85% reduction in your cost of your creative content. You're being able to reuse the things, you're not losing stuff, etc. And you'll have a 25% increase in revenue. So those are pretty compelling, components when you're in a tight economic climate. Turning to the finance side of the house, as you can see a few charts here on our operations, nice growth in quarterly revenue, up 41%. That's driven entirely by our annual recurring revenue and the deferred revenue you see on the balance sheet, right? So when we bill a new customer, as we went through the slide before, we bill those years in advance. So at the start of the contract, the auto one would have been billed to $85,500 for their ARR. That revenue would sit in deferred revenue and get amortized to revenue over the ensuing year. And so, revenue as a result ends up being a trailing indicator. But as you can see, up 41% in Q4 and 37% for the year. I believe analyst consensus is for 35% growth next year in revenue. So again, nice, strong revenue trend. On the OpEx side, you can see down at the bottom right here, the annual operating costs were up 26% in 2022. And that was entirely the tail on our 2021 doubling of the business. So in 2021, we doubled our headcount. We really leaned into the business because of the opportunity we see in DAM and because we have the cash resources to do so. So we wanted to spend ahead of the cycle so that we can drive accelerated growth in the future. That investment was completed at the end of 21. And so the increase in cost for the fiscal 2022 of 26% is really the tail on that. When you look at it on a quarterly resolution, you can see we've really maintained our spend since then. It's up only 9%, while revenue is up 41%. So we're hitting that leverage point now in the business where revenue is exceeding cost growth by a significant margin. Getting us well on our way, of course, to positive cash from operations, which is our core focus from a profitability perspective at this point. So, continuing on here, when we start to consider the cash flow aspect of the business, you really need to look at our billings. That's the amount of money that we're invoicing customers in the period. That is your current year's ARR plus your upfront setup fees plus any PS, professional services. That's what we're invoicing to customers in the period for the efforts we've done to sell and bring in new customers and support those customers and renew them. So that's the right one to compare against our cash operating costs. We call that our billings-based cash burn, right? How much money did we invoice coming in the door versus how much are we spending? And obviously our burn increased significantly in 2021 and 2022 as we doubled the business. But on a quarterly resolution, now you can see this starting to decline. We were nearly cash positive in our fourth quarter here with our billings-based burn of only $400,000, down 68% from Q4 last year. And we'll see that trend continue in fiscal 2023 here as we drive toward cash positive for the end of the year. As you can see, billings were up 41% last year to $15.5 million. Again, we've kind of seen these in the slides before, but here are the details, if you will. Revenue, 12.8 million, 95% of that is recurring, as I mentioned, up 37%. We have strong gross margins, 81% for fiscal 2022 versus 82% in 2021. It's been very steady and consistent. I expect it to continue in that 82% range. As you can see, OpEx, of course, is up, as we talked about. 26% for the year, but again, it was slowing by the end of the year and really up only 9% from Q4 21 on a run rate basis. And down below, you see the billings based operational cash flow calculation. It's adjusting all of our costs to cash basis so that you're properly comparing cash costs to your billings. And again, we'll see that nearly cut in half this year as we head toward cash positive. All right, and down below, you see Obviously, net working capital 2.3 million plus the 3.5 raised in January. So that's the 5.8 that we have available to us on hand. As I mentioned, we also have a $9 million LOC to cover any bridges needed on our path to cash positive. And importantly, we've got $10 million in deferred revenue, up 36%, which aligns with the 35% analyst consensus revenue growth. Obviously, a large part of that is coming just off the balance sheet with deferred revenue. So it's nice to have that locked in and that visibility to future cash flow. A little earlier, I touched on this press releases. Again, we'll generally announce deals 2 times our average ARR. So keep a lookout for that. And here's an example of a bunch of those, as well as a couple of examples of existing customer expansion. And you see the one here on the second bullet, $135,000 increase in ARR and plus $135,000 professional services engagement from one of our existing customers, really helping with us attain that greater than 100% net retention that we've been focused on. So good examples throughout the year in what we've been up to from a customer acquisition perspective predominantly. And then looking at our valuation metrics, as Babak mentioned earlier, it's attractive valuation point, actually trading at versus consensus ARR 2.3 times and 2.5 times consensus revenue. Whereas, the peer group is anywhere from 5 to 5.5 to 6.5, metric for that. So there's where we have the opportunity for some multiple expansion as we get closer to cash positive and, some of those large deals that we're working on as well. So, keep an eye out for that. And of course, we're shoulder to shoulder with investors, 42% owned on the inside. A lot of that bought in the open market. Actually, the last purchase I made was 6 or so months ago, and that was right around the price point that we're at right now. Plus, of course, it was all insiders predominantly that did the $3.5 million round in January. We're standing by, and that, by the way, was done at a premium to market as well. And, again, we really support the business and are shoulder to shoulder as we go to create shareholder value here. So wrapping it up, we hopefully we've conveyed the message here, but predictable high growth with upside, and again, a little bit of a historic lens here. And I touched on this earlier. In 2019, of course, was our biggest growth year for annual recurring revenue. And that occurred on the back of our platform upgrade for our UX V4. As I mentioned, we're now working on V5, and I think we have the opportunity to maybe not drive 85% growth out of it, but again, it will be part of our continued growth acceleration plans for the future. Well, we had some large customer wins in that year, and again, we're setting the stage to replicate that through some of the back-end optimization pieces I talked about that are enabling us to expand our TAM into mass video accounts and into mass customer opportunities. And in 2022, we had the team expansion that we underwent, feature development, productivity gains, et cetera, coming into play there. Of course, it was against the backdrop of the COVID years, so some disruption in growth opportunity, but we still managed to pull out some nice solid growth. And 2023, again, consensus of 26% growth, and that's just this operational leverage and team building, getting that team we built now into the norming and performing stage of their evolution. And the upside to come through V5, large deal enablement and partner activation. So I hope that was clear from the presentation. Thank you for listening in. And at this point, I'll open it up to any questions should anyone have some.
Thanks, Rob. As I mentioned earlier, we've received a number of questions by email, some more general and some more detailed questions. So maybe we'll start with some more sort of an overview questions, and then we'll dig into more detailed. The first question asked, why do companies need a DAM? Or in other words, what is the main problem that a DAM would solve?
It's a great question, Babak. And maybe what I'll do is I'll use a customer example too for this. So, let's take an airport authority, say, that's that we Canadians know dearly. And, they had 20 terabytes of digital media that they were trying to manage. It was on Dropbox, it was on SharePoint, it was on local drives, it was all over the place. And this content needed to go, on the placards on the trains, placards around the actual airport, on all the digital screens in the airport, on the digital screens in the planes themselves, in the in-flight magazines, on their online advertising, out through all of their partners to advertise why people should come to Canada, all these wonderful things. You could imagine the complexity of a job like that when you don't even know where your content is, and you have to have it in so many different forms to go and fit these places that it needs to be, and have to have a process around each of those on how you get it to the right people at the right time. So how do you get it to the right printer to get it on the train, you know? So you could imagine the complexity that the marketing organization would have to go through to support their digital initiatives. We call that chaos. And that's what most customers are in, is they try to get digital, they get into this state of chaos. And most customers don't have it down. They try to solve it with things like Dropbox or SharePoint, or those are great for for specific purposes, but not for managing all this media and content that needs to be collected together and really managed well and sent to the right places at the right time. So again, what they should be experiencing after rolling out MediaValet, 85% savings in their time and cost of managing all this content. You know, those requests, hey, can you provide me the following? And they've got to spend, you know, half their day looking for what they're trying to find. So, you know, it really democratizes your assets. It really frees up marketing's time. This is the 85% savings that they experience. And of course, a 25% increase in revenue because they're getting to market more consistently with more dynamic and fresh and on-point advertising materials in a digital sense. So, you know, this is critical to their success as a digital organization, and that's why DAM exists.
Makes sense. Perfect. The second question asks, what makes MediaValet's platform different or better than other DAM platforms, and why do you win?
Again, thank you for that. I'll actually go up and we'll just have a backdrop to that as one of the slides that we've already been on. But yeah, you know, when you look at MediaValet again, it really does come down to this. Like, again, being best in class in adoption, we have unlimited support, we have unrivaled support. We're really known for it, and that, you know, moniker "we care," however corny it may sound, the customers feel that, and we're really trying to provide solutions to them and lead them to value. And then, of course, ease of use. It's just so easy to get up and running. You know, a lot of times technology tries to be so broad in its approach and yet tries to make sure that everything for that broad approach is configured right out of the gates. So getting up and running and trying to get to the value is extremely complicated and very hard. We turn that around and say, no, just get up and running easy. And if you want to make it complex, go ahead, but you can do that over time. Let's get value immediately. And that really makes a difference. That ease of use and that time to value is critical. I think we do a really good job of that. And you know, a lot of organizations don't really have that as a core focus. So again, it's differentiating on how we deliver DAM. And then finally, of course, we're very collaborative with our customers, looking for solutions to their problems. And that makes us innovative because we find all sorts of innovative ways to make a difference in their world. And this leads to best-in-class adoption. That's how we stand out. That's who we are. And, you know, that's why we win.
Perfect. Thanks, Rob. The next question revolves around really understanding the customer base that we have. The question specifically asks, how much does your top 5 customer base make up in terms of revenue percentage? And then how long, on average, they've been MediaValet's clients? And the last part to that question, what has been the revenue growth from these existing clients?
Great. Thank you, Babak. Good questions. And, you know, this particular year, as we think about who we are and really lean into being a hot DAM, it really brings customers to the forefront. You know, if we can, you know, increase their adoption and deliver on our promise, you know, it makes a huge difference in not only growing those existing customers, but landing new customers as well. So it is a core focus of this year. We're doing lots of the development work we're doing is around things we can do to make life better for our customers and better able to increase their the amount of content they have with us and the way they use us. And so that leads to revenue growth opportunities. And the top 5 customers, or actually what I'll call it, is our top customers by revenue. So we look at that as our customers over $100,000 a year in annual recurring revenue, US. So that is what we consider our top end of our customers. And getting it right for those customers is what it will translate to is obviously revenue growth and stickiness. So they tend to be extremely sticky. By revenue, they make up 20% of our annual recurring revenue. But as I said on here, it's only 3% of our customers. So they're obviously very meaningful as a customer group. The oldest customer in that group is now in their 9th year with us. On average, we're in our 4th year. That includes the ones that were just signed last year. So on average, we're in 4 years in. These are long-term sticky customers. And I get really excited about the growth and the growth opportunity there, not just because it becomes exciting for us from a revenue perspective, because of what it conveys about the value that we're delivering to those customers and about that adoption. But that customer group, excluding the ones signed last year, their same group of customers, their revenue has grown since they signed up with us 62%. It's a staggering $800,000 US a year of additional revenue from that same 3% of our customers. So very happy with that, what we've seen there. And of course, we're focused on trying to do that throughout our organization, particularly in that middle bucket where 73% of our customers are.
Perfect. Thanks, Rob. Then next question asks, how many deals are on your pipeline for 2023? And conservatively speaking, what are the analysts expecting you to deliver in terms of organic growth for the year?
Yeah, so pipeline, and just be clear on pipeline, we actually have a quarterly resolution on pipeline because our deal cycle tends to be less than 90 days. In fact, I believe our 4th quarter was only 68 days. So we can get these deals done fast, particularly when we get to the smaller end of our customer base. So, that's exciting that you can move the needle quickly. But our marketing team, through that direct marketing effort that we're doing, they are generating between 125 and 175 new sales opportunities every quarter. So they're adding to the pipeline 125 to 175 every quarter, and of course we're closing a whole bunch every quarter as well. So the pipeline's pretty robust. It's actually stayed very responsive, and even through the current cycle in terms of recessionary concerns that we see out there from a macroeconomic perspective. For us, it's interesting. I think the tailwinds in DAM have kept it a really strong opportunity flow for us. Where we see pressure is that the deal cycles are increasing, which has happened before. It happened in 2021 and 2020. So for sure, we see those come and go. They keep gravitating back. As I said, at the end of 2022, we actually had a 68-day cycle in Q4. So it does, go through cycles here. The key for us is that we keep generating enough pipe so that we can manage through those cycles. And I think that is reflective in the analyst consensus, which is 18.65, 26% growth in ARR. I think that baseline of the things we talked about that we're doing, our best-in-class adoption, our how we go to market with direct marketing, our hot damn messaging that we're bringing to as a campaign that we're delivering behind, those will get us to I believe will get us to the analyst consensus. Is our expectation. And we still have capacity for more, as we deliver. If we can get some large wins along the way, I'm sure we've got a good shot at exceeding.
Thanks, Rob. The next question asks, how much scalability is in the revenue growth? Referring back to full year 2022 results, there was about 37% increase in revenue versus 26% growth in operating costs. Is this scalability expected to continue? Or is the cost expected to go up or further be reduced as revenue grows?
Yeah, so and looking at this, you'll see this on the slide I've just pulled up here again. You can see when you look at a quarterly resolution, you do see that scale starting to show and unlock the leverage here in the business. So revenue up 41%, but costs only up 9%. And there's going to be inflationary pressures on costs all the time. So of course we're going to be fighting a tide in terms of there's always some increasing pressure. But we're really focused on optimizing our operations and finding opportunities to be more streamlined as a business. I mean, obviously, when you double the size of your headcount, you're going to have some inefficiencies. So this year, we're really focused on identifying those and fixing them so that the spend that we do make is going to have impact. And that's going to help us to have keep this growth acceleration going. So yeah, you'll see as we get into 2023 here, a leveling off, just as you see on a quarterly resolution here in the increase in OpEx. We'll do our best to keep it in check with last year so that we give ourselves a chance to faster grow into cash positive through our revenue growth. But we see great leverage there. And again, 9% versus 41% should already show that it's starting to happen. Revenue growth for next year is 35%, and as it shows, we're at a 9% run rate increase in spend. So we should see a great leverage next year. I do want to point out one thing in this as well. We have built a foundation here that is, we acknowledge and recognize we've spent a couple years ahead. And we've done that because we have the resources to do so, and because the DAM market is growing so rapidly, we want to make sure we're hitting it and as much of it as fast as possible. And that's why we've gone out ahead like this. But we will grow into it, and we will get those back in line with industry averages. But when you look at our sales team in particular, we have 6 sales reps right now that are actually, quota carrying sales reps out there every day closing deals for us, right? And but with the infrastructure we built on the sales team, the pieces we put in place, we could handle another 4 reps without having to increase any of those foundational overheads of our sales organization. In other words, not only is there capacity from getting our salespeople to the upper end of their performance level, the people we have, but we have the opportunity to do, to increase that by another 2/3 through adding salespeople without having to increase the overheads of sales. Of course, marketing will have to increase just to get the leads they need for that. But from a sales organization perspective, we've got lots of leverage to go unlock here on the platform we've built.
Got it. Thanks, Rob. As of now, how much of your business is focused on R&D and improving the DAM platform versus sales and business development? And how do you expect that to evolve throughout 2023 and going into 24?
Yeah, when you look at R&D, right now it's about 56% of our annual recurring revenue, right? So as I mentioned earlier, we've overweighted in R&D. Industry average is about 27%. So we're double what industry average is. We'll double our sales and we'll get to it. But we also, again, will increase efficiencies, right? So that's really the focus, is to grow into the industry average. We're holding the line here now and optimizing that spend. So it actually, it'll come across as likely a decrease in 2023 when we get to the end here and look back at what R&D spend was. So, it is, we're getting the efficiencies out of it now. I think you got to think about R&D, only about 1/3 of R&D is, actually less, about 31%-ish is maintenance focused R&D. The rest of it is all spend on the future, right? So, I think that's important to keep that in perspective. We're spending on future growth this year. 2/3 of that R&D is solely about future growth. And I think when you think about sales and marketing, go to market, that's a big piece of it. We're discovering from a sales and marketing perspective, a go to market perspective, what the strategy needs to be, where we need to fit in from a product perspective, and how we can win a bigger share of that market. And R&D is delivering the pieces we need to execute on that vision. So, you really got to think of them as part of, a future strategic sales spend, if you will, or market spend. From a sales and marketing perspective, we're spending about 45% of the ARR on sales and marketing in 2022. Industry average is closer to 35%. So as you can see, usually in industries, you spend more in sales and marketing than you do in R&D. And so we've reversed it for a short period of time, and you'll see it catch up and go the other way as we grow here. So that's, the focus is to get back to industry average.
Thanks, Rob. The next question really just wants to get a better understanding of how you're planning on really growing the business beyond just organic, and if you have any acquisition plans for the near future.
So organic definitely is the core focus right now, and we need to execute flawlessly on that side, and that's what a lot of the thrust is today. But as we get, as our market cap starts to reflect what we've accomplished, we'll have currency to go and look at some of the acquisition opportunities out there. I mentioned earlier, we kind of had a slide up here where we showed some of the DAM competitors, but it is a fragmented market. There's another 20 that I could put on here that we really don't compete with every day. These are more the bigger ones we see on a fairly regular basis. But there are a lot of shingles held up in this industry, and it's fragmented, which creates a great opportunity for us. With best-in-class adoption and a differentiated DAM, as we call hot DAM, I think we have the opportunity to, kind of get some of these plain vanilla vendors and roll them up over time and pick up, revenue, pick up good people, and pick up, some unique technology pieces, because everybody does do something unique in their business, and consolidating some of those differences and accelerating our roadmap through that could be interesting as well. So as we get currency, we'll be looking to augment our organic growth strategy with some acquisitions, and I can't wait to get onto that piece of the journey as well, because as I said, I think there's a big roll-up opportunity here in DAM.
Perfect, thanks, Rob. The last question really asks about, I guess, really in today's market, being self-sustaining as a business is important, and more important than we've seen in better markets. So really, the next question becomes, when do you expect to become cash flow positive? And really, with the current capital position that you have, are there any plans to raise any capital this year or next year?
So from a capital perspective, as I mentioned, we have about $5.8 million in working capital, so it puts us in a great position for the year ahead. And as I said earlier, analyst consensus has us Q4 2023 cash positive, and then because of our deal cycle, like renewal cycles, we'll probably burn in Q1, Q2 2024, but be cash positive as a whole. I think that generally is the analyst consensus out there, and we feel pretty good about that. So we're focusing getting there by continuing to drive growth. Again, analyst consensus for revenue growth 35% for next year. Nice high growth rates. Again, we're focused on delivering that through the things that we took you through today, but at the same time, we're holding the line on costs so we can grow into that and achieve these cash positive expectations. And from a funding perspective, 5.8 is going to take care of a bunch of that, but of course there's timing differences and things like that. So as on that path, we have access to $9 million of an LOC that we can come in and out of as needed. We used $500,000 of it in Q4 last year and repaid it in January. So, we do have that lever for us to alleviate the stress should we need it. As a result, we don't intend to do a raise this year at all as a result. I think we have what we need to get to cash positive. So unless there's an acquisition to go and do, I don't really see much need to look at any raises along the way.
Excellent, thanks, Rob. Looks like we don't have any further questions. I will leave it to you, Rob, to provide any closing remarks. And I personally like to thank everyone for joining today's webinar.
Thanks,
Go ahead,
Babak.
Rob, for any closing remarks. Yes.
Thanks, Babak. Thanks, everybody, for attending today. I hope it was valuable and you were able to get the key messages that I hoped to get across. Sustainable high growth in a high growth market. Again, winning more and more leadership share. Delivering with focus and optimizing our operations, both from just how we go to market and how we deliver our services, getting the friction out of the business and making sure that we're optimally delivering as a team, getting into that norming and performing stage, getting our existing customers to beyond that 101% net retention through focus on their needs and driving value and expansion opportunity for them, just like we've done in the past with our large customers that we went through. and investing in the right platform pieces here to not only generate this year's growth and open up new markets, but to ensure that, we're setting the stage for that continued growth well into the future years ahead of us. So exciting year for us. And, thank you again for joining in, and we'll go back to focusing on driving our growth.
Thanks, everyone. Thanks, Rob. You may disconnect now.